And what's interesting about this, so I started diving in. You know, that's what I do. Boring guy, 2 daughters, my wife. What do? I get my coffee. I'm usually up early. I pop up at 5:30 every morning as it is. Monday through Friday, I'm usually up by 5 actually. But what I did was sitting there on Saturday diving into the numbers. And what was very, very interesting is because of what happened last week, the S&P, so the S&P 500, which is a large basket of stocks that matter for you and me, everything from energy to automobiles to consumer goods to pharmaceutical, the S&P 500, it's a big basket of stuff. And so it's not like the NASDAQ 100, which is primarily tech. So I'm looking at this and I'm like, wow, they had their best week, the first week of June, going into the first week of June, last week of May, coming out of Memorial Day. It's not even the end of second quarter. There's not anything big was going on except those 3 things happen. Debt deal, interest rates looks like they're going to be flat, and noise from tech that some good earnings is coming, especially from Apple. So I dive into it, but what I found, the bets on the broad market. So there's always the narrow market. How's energy? How's tech? How's retail? How's big box retail versus small retail? You have all these dialogues you hear, and then you'll back up and you hear, how's the broad market doing? Well, the broad market doing is basically the wider market look that would matter in the most areas of the economy. And on the broad market, believe it or not, the bets on the S&P 500 future, because remember, the futures, you can buy what's called an option. You can bet the market's going to go up or going to go down. Let's say the market's at 100, just pick a number. If you put an option out there, you have to put part of your money down, your number is 100. If that's an option that you think the market's going to go up and it goes up to 110, you get $10. If you bet that it was going to go down and it goes down to 90, you get $10, the difference between this. Now, if you bet the market's going to go down, then they call you a bearish options. That's what they mean. You think the market's going down, but it goes up to 110, you have to pay 10. So you lose your bet and you have to pay the 10. So that's how it goes. Well, I looked at the broad market futures, hedge fund and speculation by, individual high net worth speculators and organizations is the bearish that it's been since 2007. In other words, there's a massive amount on the broad market S&P futures that believe it's going down. So they believe that long-term it's going down. Now, why would the market be up on a Friday? We got a bunch of good news, and the market didn't go to the moon. It only jumped up a little bit. But the longer look, they're thinking bearish. Well, and they think it's the worst since the financial crash of 07, 08. Wait a minute, that's like 17 years ago, I thought. 16, 17 years ago is what we're talking about. That's correct. It is 16, 17 years ago. The being bearish, most bearish since that time. That's kind of crazy, isn't it? Well, if that's the case, why is the market up? Well, I just told you, for the short run and for going into the thing, hey, we think we're going to a bull market, not a bear market, but the broad market apparently still bearish. These hedge funds still think that there could be trouble. Now where? Well, real estate hasn't come back yet. Banks, are still getting hurt by high interest rates because they got bonds that are upside down. That's what killed Silicon Valley Bank. They had a bunch of bonds they bought at 2%. Interest rates go to 5%. They can't sell the 2% bonds. They die and they end up with a liquidity crisis and the bank fails. And we all saw how that happened. So in the midst of all this, mortgages aren't doing well. Home repairs aren't doing well. Lowe's and Home Depot aren't doing well. HELOCs aren't doing well. Consumer credit's way up, right? So you have that side of it. That is making people have a bearish view of the market because they're saying, and tell me what exactly the consumer is going to be buying with. And they want to see growth and maintain that growth, but not looking like it. So you flip that over the other way and say, well, then why was the market up? Remember I talked about tech. Debt deal, interest rates, tech. Well, tech is in a good place. They've made all these layoffs. Life isn't so horrible, and it looks like there are going to be some good earnings. And there's a lot of funds out there betting on tech. So you can believe the broad market and the economy with it are going to have tough times and a recession and things going on. You can believe that at the same time you believe, but I think tech's going to be okay. Remember, when gas prices are up, the oil stocks were doing pretty well. Was that price gouging? You can have that debate another time. But there's an example of something that looks bad. Oh my gosh, heating oil. You know, average people paying for gas in their cars to commute. Bad news. Oil stocks up. Good news. There's always using kind of a balancing effect in all this. And that's what's going on. What I like to look at is the VIX. And the VIX is a index that shows the volatility people think in the market. So, and there's also a volatility that people think is coming in tech. So let's take the VXN first, which is the VIX for the NASDAQ 100. I'll give you a little lesson here. Even if you don't watch the market, if you get up in the morning and you check the weather, also check these two indexes. These two indexes is basically a weather report, or it's kind of a hurricane map. You see those maps, picture Florida and the Gulf, and they'll have all these lines that they draw. They say the hurricane could go here, here, and here. And you have all these lines all over the place, but there's a bunch of them in the middle. So he's saying it could be anything, but right here in the middle is what we think is going to happen. Think of this as the volatility index of what's going on. And this is the VXN. This is the volatility of, and do it 1 year. Click on 1 year if you would there.
Yep.
There you go. So look, the volatility of tech seems like it's going down, but put your arrow right there in March of this year.
March, April, March.
Back up. Back up. March, 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 March. There you go. Boing, it goes up. Why? People were scared about volatility. Then there was layoffs and things going on. Suddenly the volatility starts dropping. When this line goes down the way it is, that means the market is perceiving less volatility in tech. So when this goes down, it's usually good for the tech part of the stock market. There's your weather forecast. Well, gee, Biz Doc, what about the rest of the market? Well, the rest of the market is measured in a thing simply called the VIX. The VIX is basically the broader market. We can go take a look at that one now. That one we just saw was the volatility of basically the NASDAQ 100, which is heavily weighted tech. Then we go the other side to the other VIX. We can go take a look at that. And let's do the thing, 1 year.
1 year.
And you have largely similar but flatter. You know, if you were to put these side by side, it is flatter. So they think there's less volatility in tech than there is in the broader market right now. So there you have it. That's what's going on with the stock market. The stock market got pieces of good news, had a pop-up. A lot of people think that maybe that pop-up could be the starting gun, and they're off. Bang. Like at the Olympics for the when they sprint, you know, mark, get set, go. They think that this is mark, get set, go for a bull market to replace the bear market, because we've had a bear market for a while now. And they're itching to get going again. And they're hoping that the interest rates start to drop, which will really drive the bear market. On the other hand, the Fed is worried about inflation. And there was also some reports that came out on Friday about wage growth and about unemployment. And some people were saying, yikes, is the Fed going to see that and maybe raise rates in June? I don't think there's a chance. I think the rates are going to be flat in June. Could there be a quarter point in July 25th, 26th? Maybe, but I don't see it. But nonetheless, the Fed doesn't like it when it sees wage growth and it sees what it saw, because it usually means that wages are being driven, and that's going to drive inflation. Because when wages get driven, companies raise prices. That's how it goes. So that's going on with point one, is the market, there's a lot going on back and forth. I hope we're about to go into a bull market. I think we'll get there. I'm more concerned about what matters to everyday consumers. I'm worried about the mortgage market, home starts, the ability to buy a home, rents subsiding a little bit, and interest rates coming down, which will also help interest rates come down on credit cards.